Hello everyone. Since I'm shooting this video on Father's Day, I want to wish all the fathers out there a very happy Father's Day. I hope you're having fun. Hi, my name is Preeti Rao and I am both a real estate broker and a mortgage broker for close to 20 years. Of late, I'm being asked a very important question by clients who are looking to buy homes and need a mortgage, and clients who are either refinancing and need a mortgage. The question is, should we take a fixed rate mortgage or a variable rate mortgage? But first, I want to thank you so much for tuning in. And if you are new, welcome to my channel, where we try to cover topics that are of interest to you on real estate and mortgages. So please make sure to like, share, and tap that bell icon so you get notified anytime I share an informative video. And of course, if you find the information provided is of value, then all I ask is to hit the subscription button to get me motivated to keep you up to date with everything real estate. So, before we dive into details, let me tell you, where we stand today, both the fixed and the variable rate, they're not very far from each other. And the way the rates are climbing, oh, God help us all. But the fact is that if you go back 20 years, the average fixed rate was around 6.5% and the variable rate was around 3.95. We are very close to approaching those interest rates. But in 2002, the average home prices were $300,000 to $400,000. Nowadays, you won't even find anything reasonable in that price range. Hence the panic. See, house values today make no sense. And with such high values and high interest rate, it's going to make payments burdensome and unmanageable. So why is this happening? Now, in the recent months, excess demand in the Canadian economy has pushed the inflation rate to 6.7%, the highest in 31 years. So the central bank's response to excess demand was to raise the interest rates, which they did in March of 2022 when the Canadian economy was back at its full capacity. And that is one of the main reasons why we are seeing these rate hikes. Now, when it comes to the variable rate, it's calculated something like this. The Bank of Canada sets the target for the overnight lending rate, which is the interest rate that the banks charge each other to cover their short-term daily transactions. The target overnight rate also influences the banks set as their prime lending rate. The prime rate is what banks charge the customers. So, from the Bank of Canada's target rate, rates are set by the banks in a cascading effect down the chain, i.e. you and me. Now, this change in the target overnight rate only impacts prime rate, which in turn impacts the variable rate, which in turn also impacts HELOCs, which are home equity line of credit. But the fixed rate does not fluctuate, nor is it impacted by the target overnight rate. As a matter of fact, it's affected by the government bond market. What is a bond market? Simply put, it's a debt security issued by the government to support the government's spending and obligation. How do bond yields affect mortgage rates? Well, government bonds are risk-free investments, while mortgages are risky investments. So to make up for that risk difference, there is a premium added onto the mortgage rates above the bond yields. This compensates banks for the additional risk that they are going to take by giving us the mortgage. The thing is, everything is connected. The world economy, the Canadian economy, all of that impacts the stock market, which in turn impacts the bond market, which then impacts the interest rates. Now, I can go on and on about this, and I'm sure I have missed some pertinent information. But if I delve into this, then I'll be putting you all to sleep. So, coming back to the main point of today's topic, fixed, variable. When a client asks me these questions, my answer to them is go variable. And yes, they look at me like I just grew horns over my head right in front of them. But this is my logic. By law, fixed rate mortgages in Canada are compounded semi-annually, which means twice a year unpaid mortgage interest is added to the principal amount of the loan, whereas the variable rate mortgage can be compounded monthly or semi-annually. But don't worry, my friends, the variable rate mortgage is also compounded semi-annually in Canada, so there is no difference there. But what differs is the interest rate. Currently, the 5-year fixed is anywhere from 4.39 to 5.94. Let's say you are a first-time home buyer and you only have 10% down. You get lucky and your 5-year fixed is now 4.39, amortized for 25 years. Now, for a $600,000 mortgage, your payment would be $3,285. Then you say, okay, what if I go variable? Then your interest rate would be anywhere from 2.65 to 3.50, where your monthly payments for the same 600,000 at 2.65 with a 25-year amortized would be 2,733, making the difference 552 per month. Now you're happy and you have closed your deal, but life sucks and prime just went up by 50 basis points, taking your interest rate from 2.65 to 3.12. Your monthly mortgage payment does not change. What changes is the amount going towards the principal and the interest. More goes towards the interest and less towards the principal. At that point, you can increase your monthly payment by $100. I would recommend doing that. But if you cannot, that's okay too. Just be aware that more is going towards the interest and keep an eye out on the increase. When you take a variable rate mortgage, the only situation that you need to take care of is that all the money that you are paying should not go towards the interest only. But for that to happen, the variable rate needs to be up there. Probably so would be. What the banks fear in scenarios like these are what's called as the balloon payments. They are afraid that if the prime keeps going up, and then people will end up only paying the interest portion of their mortgage, and when the amortization touches the 25 years, you will still have a huge amount of principal balance left. But this is very, very unlikely in today's day and age. I've seen this happen in the US, but here it does not. Banks do not like risks, and that is why they will hound you to move to a fixed. I still stand by my opinion. Stay variable, and I have another strong reason for that. Like I said in the beginning, mortgages in Canada are compounded semi-annually based on the interest rate you have. So think for a minute. Compounding your mortgage at 4.39% ROI, which is rate of interest, and at 2.65 ROI. Which interest payment is going to be higher? And that interest payment gets tagged on to the principal again. But yes, you can turn around and tell me, we are on a budget. We cannot afford this $100 a month towards our mortgage. And what if it just keeps going up? Guys, the market and the rates will not always be like this. At times like this, stay put. Focus on making those payments. Once the economy and the world stabilizes, things will get back to normal. And honestly, what if this is our normal? When I bought my first home, my interest rate was 6% and I was elated. Then, over a period of time, rates just kept dropping and people forgot. New immigrants came in and bought homes at 1.2 ROI rate of interest. Extremely happy because back home they are paying 12 and 13%. So what if this is how the rates are going to be for a longer period of time? House values will come down. Sellers and sellers agents can no longer be greedy. They will all have to be reasonable. The only sad part is that the house value is incomparable to the interest rates. They don't match, making it again very difficult for a first-time home buyer. So if you are out there contemplating, should I buy or not? Call me. My information is in the description box below. I would love to chat and get your take or your input and your understanding on this matter. So, to sum it up, yes, there is a major confusion on the fixed and the variable. But guys, variable in the long run saves you quite a lot of money. My opinion. Choose variable. So, if you found value or you like this video and would like to see more content, click on the boxes on the screen. Once again, my name is Preeti Rao and my contact information is in the description box below. Make sure to hit like, share, subscribe and the bell icon so you don't miss any future videos. Thank you for watching and don't forget to call me because I hold the key that opens the door to your dream home.